All right, so welcome to Wook Capital's ninth Wook in Review. We're going to be reviewing some congressional midterm results, the implications on the investment landscape. We'll talk a little bit about ESG investing and see where the conversation takes us after we get through the prepared materials. For those who don't know, I'm Rod Alsman. I'm the managing director at Wook Capital Management. I have Joe Fonicello, my social media manager, joining me to moderate the discussion. We're going to just get, if I can just get my disclaimer out of the way here. Just need to let everybody know that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of investment loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any actions you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So, with that said, yes, Joe, I bought several $100s worth of audio equipment. I have this lovely Shure microphone that came just a half hour or so ago that I haven't had a chance to set up yet. But as you can see, I've got a nice little old man headphones going on. So my audio output is coming through my iPhone. It's a little smoother, but once we get the Shure mic set up next week, I think it'll be smoother still. So yeah, we're going to walk through the prepared materials. I think it'll take about a half an hour, and then we'll run. We may run just the full hour. We may run 2 hours. We'll see where this conversation takes us after we get done with the prepared materials. So, with that, let me get the proper screen up. Um, uh, uh, nope, that's the wrong desktop. 1 second. Why does it does this every time, Joe? It literally changes sources
That's
on me.
okay.
It just doesn't want to make my life easy for the technology novice that I am. Um, I can probably just move. I can't figure out how to switch source. I can just move everything over to the screen. Worst case.
Yeah, probably just move things. It looks good. We can see your screen. We can see the Wook
Okay.
on the left there. Yeah, there you go.
All right. So okay. So book and review. Um, Sorry, I'm like trying to do 8 things at once, and it's not working very well. So yeah, look, we got midterm results that have finally gotten to a point where there's been some good commentary on what we can expect. It's going to be a mixed bag. It's, if you were a Republican expecting a red wave, you're probably disappointed. If you were a Democrat hoping to retain control of both houses, the House and Senate, you're probably disappointed. So disappointment across the board is probably a good thing for folks in the middle. Um, so we'll talk about some of these interesting, you know, Jesus. We've got the new ETFs that Unusual Whales is rolling out shortly that we're going to talk through a little bit. We're also going to talk about ESG investing. So before we do, there's a couple highlights I want to kind of get through to talk through about that have been happening over the past week or two. Obviously, we didn't hold the broadcast last Friday, observance of Veterans Day. We've got Thanksgiving, Black Friday coming up this following Friday, so I'm not 100% sure if we will do the broadcast. We'll communicate that in Discord as we get through the weekend. But obviously, we have to talk about the FTX situation, and if you've been living under a rock, FTX is Sam Bankman-Fried's crypto exchange, VC investment vehicle, whatever you want to end up calling it. It's still unclear, even to the head of the bankrupt entity, exactly what it is that he has. You've got effectively, just to recap what happened, you had 2 weeks ago now, the head of Binance, one of the competing crypto exchanges, had basically come out, and there's a little bit of a spat between him and the head of FTX. And there was a run that it basically ended up exposing that there was a massive fraud at the core of FTX. Alameda Research, the trading vehicle, had effectively been using customer deposits um, in effectuating their business. So both FTX, Alameda, all of these entities have filed bankruptcy. There's a slate of uh, I've been following it, and it's like it's just a complete clusterfuck, to put it bluntly. There's the Bahamian entities, there's the Bahamian regulators, there's the fact that the U.S. based entities are Delaware based. So people arguing kind of over whether this should be heard in bankruptcy court in Delaware or in Bahamian court. And it's as the new FTX CEO, John Ray, who oversaw the Enron bankruptcy, noted, he's never seen anything as bad as FTX. The quote is, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information has occurred here." So that was in Ray's filing with the District of Delaware bankruptcy court yesterday. And the question mark now is, how deeply does this permeate through and prospectively beyond the crypto space? Will it permeate into traditional financial space? There's more questions than answers um, when it comes to. Sorry, again, I trying to figure it out as we go. Again, I have the visuals on in the Wook Discord server. You can just type wook.gg in your browser to join the server if you haven't yet. The only barrier to entry is we simply ask that you introduce yourself so that we can mitigate spam and have a sense of who's in the server with us. And I have the visuals. I'm just walking through kind of a couple of the Wall Street Journal stories from this week. So, you had the story on Wednesday in the Wall Street Journal talking about Genesis, which is a major lender in the crypto space, suspending redemptions and new loan originations following FTX's collapse. They've also hired advisors to explore all options. Obviously, bankruptcy is on the table as well. They had 2.8 billion in active loans at the end of September. So while it was down from what they had lent in June, we're still talking about multi-billions in outstanding loans by this company. And this is on the back of kind of all this destruction that's been seen in the crypto space year to date, on the back of various leveraged entities like Three Arrows Capital and now, of course, FTX just failing. But I think the main take I had was, the quote from one of the crypto market makers saying, Genesis in crypto is about as systemic as it gets. So, with them pausing withdrawals, obviously there's a crisis of confidence now across this entire centralized aspect of crypto. Uh, Certainly remains to be seen how many survivors there are on the back end of this in centralized crypto. From a regulatory aspect, we'll get into the kind of conversation of what may come as we talk about the split House and Senate from a regulation stance. But the space has historically been underregulated, and I can only conclude that this sort of egregious fraud could not have happened if there were regulation. That's my take. We also got news today, just this afternoon, a Wall Street Journal news exclusive. So it wasn't in the Wook and Review letter, but you saw the Wall Street Journal report that Sam Bankman-Fried cashed out $300 million during the funding spree, and that when they raised 420 million in October of last year, basically the bulk of it went to Bankman-Fried. Um, so there's still uncertainty around who knew of the fraud. Was it just him and a couple others? It sounds like the bulk of the reporting has concluded it's a very narrow circle that was aware of the depths of this fraud and usage of customer funds. But if he's pulled out hundreds of millions, um, yeah, just another very bad look. And I didn't include the Vox interview, but if you haven't seen the Vox kind of Twitter DM interview that he had, again, just paints a very bad picture. and kind of building on um, what John Ray had said, that there's basically going to be a comprehensive, transparent, and deliberate investigation into claims against Mr. Bankman-Fried. So yeah, it's just bizarre, the entire scenario. You've seen some puff pieces out of the New York Times and Washington Post. It's very bizarre to see this kind of painting a picture of I guess a very positive light, it seemed, in the New York Times puff piece, and the Washington Post also kind of puffing up Caroline, whatever her last name is, the head of Alameda. So there's been great reporting on Twitter throughout this whole thing. To be quite honest, I think that it's highlighted the value of Twitter as a instant communication protocol that can help crowdsource information worldwide in very short order. But obviously, the formalized bankruptcy processes are going to take some time, just given the complete and utter lack of any financial infrastructure. It seems that this multi-billion dollar, what was it, peak value, I think 32 billion of FTX, for it to have just a complete lack of any sort of um, infrastructure. I think Matt Levin's from yesterday, uh, his money stuff. I think it was yesterday. Again, losing track of time, but he kind of laid it out, I think, fairly. That if you look at it, if you try to look at it from the perspective that perhaps this wasn't all intended to go wrong, you might just conclude that it was some kids fairly fresh out of school that got in over their head. But when you consider the billions of dollars in damages that will be caused to customers and creditors across the way, you know, I certainly hope that they are punished to the fullest extent of the law, if the conclusion is that it was fraud, which that's my sense at this point, is they knew what they were doing. They clearly weren't in a state to manage this sort of an enterprise, but clearly there's a lot of illegal activity that took place in my view. The question becomes then, what illegal activity does it fall under? I mean, given the lack of regulation in the crypto space, will regulators or enforcers try to use some different older school, I guess, enforcement mechanisms? Again, I'm not an expert on it, and if we get after we get to the prepared remarks, if there are any legal experts who have some perspective to share, would certainly love to hear that. So that's kind of the whole FTX and crypto contagion situation. So still big open question mark there. Tech layoffs escalate, and we talked about this 2 weeks back. We kind of talked about how November to date, even only a week into November, had already been trending for the most layoffs on the technology side of things that we'd seen year to date. And as you can see from the visual from TrueUp.io, so there's two good tools, TrueUp.io and Layoff.fyi. I think you can use either one of those two data sets to kind of get a good both visual and also kind of dig into the granular data if you want, of what's going on in technology layoffs. So just both of them, you can see, agree that massive. November, we're at on the 18th, and you're already at more than double any preceding month's layoffs. So there were some good conversations. I see Dylan's in the audience. We were in a spaces with Monative Wealth, and I think he was sharing some good perspective from someone in the Valley, kind of around the timing of some of these layoffs as we head into kind of performance review season. Obviously, when you think about stuff like Twitter, there's an idiosyncratic nature to Mr. Musk's decision making there, but we've got Meta with the big layoffs on the back of the equity just getting absolutely hammered because the market basically said to Mr. Zuckerberg, "What you're doing, we're not buying." And we kind of talked ad nauseum about how far face the artist formerly known as Facebook has fallen. But this is what the Fed wants to see to an extent, right? The cooling of the labor market. This is kind of tech oriented. So we keep highlighting this, and we'll continue to follow what's going on in the layoff space. Um, Consumer spending data came in for October yesterday, and I think that the takeaway was that consumers by and large are still in aggregate well situated to continue to spend. The data in October showed a 1.3% increase on a seasonally adjusted basis compared to September. So, consumer is what, 68% of GDP, consumer spending. Obviously, services is roughly two-thirds of that, and goods is roughly one-third of that. So you heard also this week, right? You heard Walmart report results, Target, a lot of the big retailers reported results this week. And I would summarize my perspective as consumers across the board, especially, let me exclude your top quartile, high net worth consumer, high income consumer from this, but the Walmart report kind of talked about even consumers making up, up to 100,000, kind of shifting their spend toward Walmart. You think about them trying to get the best value they can for their dollars. Um, you're seeing evidence of that. Obviously, the lower income consumers are still very pinched. Walmart execs noting that their savings are dwindling, spending on necessities elevated. So when you think about where Walmart saw sales going well in food and necessities, not so well in discretionary items, apparel in particular, and then the Target call kind of talked about that as well, where Target is less price competitive on net than Walmart. So they are feeling it more than Walmart, I think, because Walmart inherently is going to be the cost leader and people are going to shift their spending there in this challenged environment. Um, and just to correct myself, it was the households earning over 100,000, not up to. It was over 100,000, helping push grocery sales higher. So you think about people trying to, again, stretch their incomes, and even when you think about $100,000 income, it's still multiples of the median income. Well, I guess on a household basis, it's a multiple, not multiples plural. But yeah, just consumers getting crushed on a lower end, and even higher end consumers starting to kind of trade down. It'll be very interesting to monitor how this holiday season goes from last season you had this kind of spread out spend. You had, you know, uh, this desire to front load bringing in shipping containers as shipping rates had gone haywire last year. This year, shipping rates have normalized a lot, and a lot of retailers front loaded a lot of their, bringing aboard inventory. Walmart's inventories remain fairly elevated. Target's even more so. Depending on who you are, you're either going to look to take price down and lower margins, or you're going to straight up send some of your excess inventory to liquidations, which I know I've seen Target has done to some of these like off brand discounters. So it'll be interesting to see where this holiday goes with consumer spending still holding up fairly well, but there's just these mixed data points when you look at like checkable deposit data point showing that on net there's a lot of money sloshing around in consumer checking and savings accounts. But then when you slice and dice that data a little differently, you see that the folks in the lower end of the totem pole are really struggling. Folks that are maybe middle of the pack are starting to feel it, but the spending data is holding up. And then the other data point that goes behind that is what came out of the Federal Reserve Bank of New York on the 15th, kind of talking about total household debt and seeing a big uptick in consumer credit card balances in particular. So the quote from the economic research advisor at the Fed is credit card, mortgage, and auto loan balances continued to increase in the third quarter of 22, reflecting a combination of robust consumer demand and higher prices. New mortgage originations have slowed to pre-pandemic levels amid rising interest rates. So there's a visual here kind of showing the quarterly change, and you can see a big uptick in credit card debt. So while the total credit card dollars are still less than a trillion, that I think it speaks to the fact that some consumers are instead of necessarily cutting their keeping up with the Joneses spending, or maybe it's essential spending, they're putting essential or other spending on credit cards to kind of keep themselves maintaining that level in light of high inflation and these high costs. Um, Auto debt, obviously, with rates now rising, that'll be interesting to monitor what happens in the automotive space because you have such a deep um, a big cumulative loss of production on the automotive side, and that extends beyond just consumer automotive. But when you think about all of the vehicles that were not produced at the trough of COVID, and also as a result of the lack of semiconductors, automotive typically is a challenged space in a recessionary environment. But it'll be a little bit noisy this time, I think, due to all of that cumulative production that still kind of needs to flow through the system. Some of you have heard me discuss this on different venues. On the trucking side in particular, fleet buyers are buying equipment, not because they want the shiniest, newest car or truck, but because they want to optimize their total cost of operation, their total cost of ownership, and newer equipment is more fuel efficient. But the fleet, by and large, you've heard PACCAR's CEO talk about it on the truck side. It's still, 10-15% older than it should be. So there's a lot of replacement demand on both the consumer and the commercial side that I think will help support um, kind of the transportation equipment, but the values have to come down. We've seen that in the Manheim index. I've seen a few tweets about um, Tesla in particular, for whatever reason, as an OE, seeing the value of its used equipment really falling off. But that should be a broad-based thing that we should see automotive used prices, used equipment on the commercial side, all really coming down, but it may not come down as steeply in some spaces due to kind of that backup or that missing production. So, all right, continuing through the paired material here, election investment implications. So it's 4:24. I think we'll get done with this in about 15-20 minutes. There's a lot to talk about, and I'd be happy to hear some different perspectives on this. Obviously, it was earlier this week that we finally got the call from the Associated Press that not the Democrats, but the Republicans will be taking control of the House of Representatives, whether it's 220, 221. They needed 218 and they got to 218. They're going to get a couple of a buffer. And it's going to be interesting because on the House side, you'll now have, a mid-single digit buffer, low mid-single digit buffer of Republicans who can kind of effectuate stopping the House from doing what maybe leadership wants. And then on the Senate side, we know the Democrats will have 50. In all likelihood, they'll have 51 once the Georgia runoff is resolved, which will actually give them a little bit more flexibility on the Senate side than they had previously, with the 50-50 split requiring Kamala Harris to break any of those ties, giving Manchin, outsize, and Sinema outsize kind of influence on policy. But again, that was back when the Democrats had all, both houses of Congress. So now that it will just be the Senate, and that really limits what they can do. They can continue to confirm Biden appointees on the Senate side. The House Republicans can opt to kind of cause trouble, if you will, for the president. This was a law firm's take on kind of the big takeaways, Meyer Brown, that I have up on screen, that I included the link in the write-up. Now that the election results are clear, they put this out on the 17th, so pretty fresh. Their perspective kind of aligns with what is natural, right? It's a split Congress, so inherently you're going to have a slowdown in any sort of you're not going to have any Inflation Reduction Act or any major legislation going through. You're going to probably have this issue with the debt ceiling. So there was initially reporting that the the House and Senate in the lame duck session might opt to move forward. I saw reporting out of Politico just I think yesterday talking about, or on Wednesday talking about, the White House's hopes for a lame duck debt ceiling deal are fading fast. So what that will instead mean is that come late spring, early summer, you'll have assuming the lame duck doesn't solve it, you'll have coming up on the borrowing limit. You'll have some form of agreement ideally reached before exceeding the borrow threshold and causing the Treasury to be unable to keep borrowing money and causing our country to prospectively be in a form of default, which nobody really wants. But this is inherently kind of the politicking that will happen. So this will be interesting to monitor. I'm sure the mainstream media will talk about it extensively in the coming months, assuming this doesn't get resolved in a lame duck. But that's the big item that this divided Congress seems to lead to in the very short term. Beyond that, kind of debt ceiling brinksmanship, you're probably going to look at minor legislation. So they cite crypto, which inherently makes sense given what we just talked about, that there could be some crypto regulation. What shape that takes, I think it's too early to say. It kind of refers to some different bills that were floating around on the House and on the Senate side that could be draft legislation. China, I think it's interesting. You've seen the Democrats under Biden shift more in line with a Trump-esque kind of combative policy. You did have the meeting with Biden and Xi earlier this week that seems to yield some positive vibes, if you will, some positive sentiment, I think was the reporting sense that I got. But what sort of uh, continued kind of what legislation will come out of Congress, if any, to kind of support restricting China's access to cutting edge technology. We saw that kind of on the chip side a few months ago. It does seem like there's some bipartisan support to limit China, whether there's some sort of a TikTok bill, right? We'll have to monitor that. But it sounds like crypto, China, those are the two that there could be some bipartisan legislation for in this new Congress. And then, of course, you'll have all your little, tax extender stuff that expires every year, and your must-pass reauthorizations that you'll have a must-pass National Defense Authorization Act in late 23. You'll need to address the FAA reauthorization and the Farm Bill. So, like how those flow through Congress in terms of people, adding little, Republicans will probably try to make it look bad for Democrats, and Democrats will try to make it look bad for Republicans, and vice versa. But those sorts of bills have to get passed. It just matters, will any little novelties get appended to them before they pass? And of course, there'll be investigations from House Republicans into the Biden administration, and surely a bunch of noise will be made around that. But that's kind of the general take. So then to kind of segue into the ESG oriented piece, there's a Bloomberg Law story out yesterday morning, kind of talking about what Republicans are going to do with ESG now that they have House control. So there was also the story and kind of talking about ESG and CNBC, a month back. You've got Florida and Texas kind of trying to do these anti ESG maneuvers, and I think it all gets back to like ESG is such a buzzword. What does it actually mean? I think we can talk a little bit about that. One thing I pulled up from the CFA Institute. I pulled up this report from a few years back on ESG integration in the Americas and like their main findings, for example. I'll read a few of them off. So there's no one best way to do ESG integration and no silver bullet to ESG integration. Great. Governance is the ESG factor most investors are integrating into their process. And I think that intuitively makes a lot of sense, that all else equal, a company with better governance than worse governance does deserve to rank above one with the worst governance. The environmental, I think, is where there's a lot of noise, right? You talk about like the phase one, phase two, phase three emissions on the environmental side. And then, of course, social. So environmental and social factors are gaining acceptance, but from a low base. Now, granted, this is a 4-year-old report, so some has changed since then, but by and large, I think that the ESG integration is farther along in the equity world than in fixed income. Portfolio managers and analysts are more frequently integrating ESG into the investment process, but rarely adjusting their models based on ESG data. The main drivers of ESG integration are risk management and client demand, and that's broadly institutional client demand. And the main barriers are limited understanding of issues and a lack of comparable ESG data. I think that last point is a big one. Comparable ESG data, right? There's very limited like consensus on what outside governance on what makes the E and what makes the S. Investors acknowledging that the data have a long way to go, but advances in quality and comparability still have a long way to go. Same thing. It would be helpful for issuers and investors to agree upon a single ESG reporting standard that could streamline the data collection process and produce more quality data. No shit. Many workshop participants were concerned that ESG mutual funds and ETFs offered to investors may be driven by marketing decisions and may not be true ESG investment products. Yeah, that right there kind of hits the nail on the head. How much of it is truly marketing versus a real quantitative process to compare and contrast these three different criteria along in a spectrum. So there was one bullet. I'll read one last bullet from the report. Investors should focus on ESG analysis, not ESG investing. ESG investing is often used as a marketing slogan, whereas ESG analysis is a fundamental part of investment analysis and requires a disciplined and tangible approach to be fully integrated into the investment process. In the long term, we expect the term ESG investing will fade away as ESG analysis becomes more accepted and as simply a part of investment analysis. So I think broadly in ESG, the issue is there's not an agreement on what, comparing apples to apples when it comes to the E and the S. There's a lot of apples and orange comparisons with the E and the S. There's a lot of marketing without substance in the space, which isn't to say the space doesn't have some perspective value. I think, again, thinking about the G, governance, it's a material issue for the company. And the E and the S, those are material considerations. How do you conduct your analysis into the E, the S, and the G? I think that's where there's a lot of disagreement. Obviously, many on the Republican side, I'll especially from a political posturing perspective, when you think about the governor of Texas and, of course, the governor of Florida, who has his own future political interests at heart, and this kind of pushback on woke corporations, as the Florida governor DeSantis notes. I'll read a quote from him from the CNBC story. Corporate power has increasingly been utilized to impose an ideological agenda on the American people through the pervasion of financial investment priorities under the euphemistic banners of environmental, social, and corporate governance and diversity, inclusion, and equity. So that was a July 28th statement announcing that Florida would bar its pension funds from considering ESG criteria in making investments. So, the fact that Florida pensions can't even consider ESG now on the back of that decision from DeSantis, to me it seems like where you've taken things so far extreme in one direction so as to preclude even considering those metrics seems like the wrong answer. But again, I think there's a bit of political posturing there from the DeSantis camp. So look, ESG, that's one angle to it. Then there's the actual the politics behind what are politicians actually investing in. So it was about 2 months ago that Unusual Whales put out this announcement that there would be a Democratic trading ETF and a Republican trading ETF. The Bloomberg reporting on it noted that congressional trading is an online fixation, right? You see it all over Twitter. You see people interested in what Nancy Pelosi or others in Congress are buying or selling. So Unusual Whales is going to move forward with this ETF product, which I'll be quite honest, it's 100 basis point management fee, and they're going to construct a portfolio of between 500 and 600 holdings based on regulatory filings from both Democrats and Republicans. So when the member of Congress sells, they will sell out of the ETF. And when the member of Congress on that side of the aisle buys, they will buy in the ETF. There was a New York Times story. There's been extensive reporting. To Unusual Whales' credit, they put out this congressional trading report in 2021 that was pretty exhaustive. New York Times put out this report a couple months back that was pretty exhausted, showing that nearly a fifth of congressional trades show possible conflicts. And there was one study that I saw that basically concluded that there's not alpha being generated on net in these congressional trades, that the aggregated performance is not exceeding random stock picking for at the 95th, 99th percentiles, which obviously isn't to say that there aren't insider trades happening. And there does seem like there's some bipartisan agreement that amending the Stock Act or passing a new bill that replaces the 2012 Stock Act that was intended to deter some of the potential for insider informed trading. I guess the finding is that there's no evidence of superior investment performance, which of course doesn't mean that there isn't there aren't bad actors, and there aren't, things going awry in this space. So it's interesting that there's just yet another ETF that people can decide to throw their dollars into if they're interested. Um, but I think that about wraps kind of the prepared discussion that I had on ESG, on Congress, on crypto, and on the consumer. So, Joe, I'm going to STF you for a moment, let you chime in. And if anybody who's in the audience wants to chime in, we're at 4:38. So we got through this in about 30 minutes, which is great. Happy to have anyone add to what we had to say or take the conversation in a different direction.
Yeah, I'd say the ETFs from Unusual Whales is more just a marketing stunt. It gets the name Unusual Whales out there, gets these tickers on the market that people can talk about and bring some awareness their way. In the same way that the Jim Cramer ETF, the inverse Cramer ETF, it's just fun. I don't think anyone expects it to be part of a diverse portfolio, but it is it brings attention to the matters and it's funny. So I give him props for that. On an unrelated note, we had Grinder go public today via SPAC. Rod, are you a buyer?
Yeah, I saw people talking about that in the GMEDD Discord. So, anytime these hot stocks show up, and I'll be honest, I don't even know if it was a D-SPAC or an IPO, but yeah, I would argue that retail investors should steer clear of any recent IPO or D-SPAC unless they're just looking to have fun trading. In terms of investing in this sort of thing after it runs up 200 or 300 whatever percent. I don't even know what the ticker is, Joe. I'm trying to find it. And
Grind.
I searched grinder stock and I got a whole bunch of grinders and power tools. So Google didn't help me
There's
there.
no E. It's actually the ticker is GRND. Its market cap is significantly higher than Playboy's.
Okay, I'm seeing the Barron's story now with a drag performer performing outside the opening this morning, it looks like. So must have been an exciting morning in downtown Manhattan. Yeah, 214% on the day. I have to imagine that. Okay, wow, got all the way up to 70. Yep,
No, it was, yeah, up all the way to 69.
fitting. Yeah, no, I certainly won't be investing in it at that level. Maybe in
Yeah,
a
I'd
year or
say
two
I'd
I'll
say
take a look.
69 was a pretty obvious top.
Yeah, like obviously I'm not a SPAC expert in Turtle. I know your profile wants that one more SPAC boom, and you're in the audience listening, but like a lot of these for early day like SPAC actions, there's nuances with like how much of the float is locked up, and you'll just get a lot of really weird trading activity from a lot of this stuff that has no bearing at all on fundamental reality. Um, the ins and outs of Grindr's financial performance, I have no insight into that, so I can't really speak in an informed manner. But I'm just scrolling through this Barron story, and I'm like, really? You literally just put a whole bunch of pictures, and there's really not much detail, financial detail. Uh, their noted revenue grew 42% in the first half of 22 to 90 million, with adjusted EBITDA of 42 million. So that's pretty nice adjusted EBITDA margin, but I don't know, how much of that is real, right? Anytime you look at those adjusted figures, you really want to go into the reconciliation and understand, what sort of bullshit they're trying to add back to come up with that adjusted figure. Um, that is interesting though, that only 6% of Grinder users pay for the service compared to 9% at Bumble and 18% at Match. So I guess you could argue there's a bigger monetization runway at Grinder. Although, I know the way the app is often used is maybe not people who are interested in having a subscription on their credit card showing up.
Well, that's why they have to put it on the credit card as something else.
Yeah.
But I'm trying to think what else is interesting. So we talked about FTX, the collapse of FTX. I think we're waiting on. I don't know if I want to say it, but there's supposed to be some sort of sex tape being released that
Oh, geez.
we're waiting on the leak of that. There was a web page put out saying that it was a company insider looking to expose.
Well, I know that Joe, you've got a spicier tape than that that's coming out in the next few days, but we can't really talk about it yet. But next week will probably be pretty busy on the back of that.
Yeah, I mean, should be better. Should be better experience putting that out than Sam's rain just falling into it. Oh my gosh, it's just terrible. It's wow. And then you can't expect this to just like mark the end of a crypto winter. It's gonna just take crypto down with it. Um, but well, I'm staying up to date on that. And Twitter has been the best example of crowdsourcing the research on that. It's so much more accurate than what the mainstream is putting out. Like the New York Times puff piece and everything else has been terrible. So just watching. I mean, you can actually stay up to date better on this reading Elon Musk's Twitter than you could reading any mainstream source. So definitely entertaining, and I love watching it.
Yeah, what was it last night? Everyone was sharing their Titanic moment with regard to Twitter on the back of the reporting that Elon has laid off so many folks who are essential to keep the organization running. And we had an interesting conversation, I think it was yesterday, with Monative Wealth and kind of talking about what percent of, and we had the conversation on Wednesday, and you and in my space is kind of talking about what percent of employees can you cut as bloat before you start to cut bone when you're talking about these technology companies. And it seems like the consensus is somewhere around the 20%, 25%, maybe a little more than that. And any more than that, you're starting to cut into the bone. And in the case of Twitter, if you're going to lay off up to 70%, 50%, whatever the number ends up being, I've personally noticed a deterioration in seeing all of the notifications on my account. I won't see like everyone replying to me. I'll randomly come across it later, and that started just this week. But the conversation last night on Twitter was that in the coming days, the platform itself may become unusable because of, I guess, how many essential or necessary engineers have been let go from different components of the business. And as everyone knows, I'm not a technology guy, so I could be misspeaking there. But uh, whether Twitter survives in this transition that Musk is effectuating, I mean, he basically laid out in that letter he sent to employees 2 days ago. You need to either come in here and absolutely work your ass off, or uh, get out. And you know he certainly has a very combative approach with the employees at the company that he's acquired. It definitely remains to be seen where Twitter settles when the dust is through. But Monative, thanks for coming up. Would love to hear you add some thoughts to expound on that, maybe.
Yeah, I just wanted to say something quick, right? So when we were talking that 20 odd percent, it's more in relation to, okay, what is let's back up for a second. So there's certainly massive bloat in many tech companies, if not all of them, and that level of bloat varies. So you could potentially say that you lay off a certain percentage, not only do cash costs go down, but the productivity could possibly improve because these people are out of the way, right? So underemployment, right, is reducing. So in general things improve, but it gets way more complicated than that. One that assumes that you're laying off the right people, which is never possible. You can get halfway there. Point being, when you start these mass layoffs, you tend to lose a lot of good people who get into that list because they can get their 2, 3, 4 months, whatever the package is, and go comfortably find something elsewhere. Maybe less so these days, maybe for the next few months that might not work, but in general, that's the case. The real catch where Twitter is different is, let's say the company has really not been delivering. Let's stipulate that's true. It's not been delivering much, if any at all. It's just keeping lights on. Now, if you just needed to keep lights on, stabilize the product, and keep moving forward with what you have, then maybe 30-40% is not that far off, what you needed to cut. But the challenge is Elon is trying to improve things. He's trying to change things. He's trying to add functionality, features. He's trying to take it
Yeah,
in
it's
a
not
new
a
direction.
keeping light on, it's actually modifying,
That's right.
migrating, changing.
So
Yeah.
so then the question becomes, okay, you do cut back 40. Let's say at the end of it all, it becomes a 60%, retrenchment, right? At least partially you have to replace that with much higher quality people to do what you want to do. And that's where, I think that's the catch in all this and this is common to tech companies. You could keep lights on with a very small group, but that's really all you can do. If you really want to make some wholesale changes, if you do cut back to the bone, then it assumes you did not have the right kind of people to do that work, so you have to replace them with the right kind of people. Is this a good market to do it? It might be. It might be the absolute best market, at least in the last 4 years, because you have a lot of good people available. But it's also, how do you attract them when you start saying things like this? When you start picking on, some piddly engineer on Twitter and bury him just because you can.
You mean that's not a healthy workplace
That's
environment?
right. So that's the catch. That's what I was trying to say yesterday.
No, that's excellent. Thank you for clarifying that. So I think the point being, if you just want to truly keep steady state, maintain the status quo, you could cut pretty darn deeply. But to do what Elon Musk is doing here, which is not that, he's actually looking to reorient and add features and revamp the entire Twitter protocol, I guess. For him to believe that he can make do with the the swathe of cuts that he's, I guess, publicized, it doesn't seem like it adds up. Remains to be seen. Obviously, the Elon doubters and haters have been proven wrong before, but in this case, it seems like he might have bitten off more than he could chew, and maybe his approach is not the best way to go about it. But remains to be seen. There were a couple other things. I'm looking back at my notes from the week that I wanted to point out. So one point when we were going over the kind of lay of the congressional land, there was one other point that I wanted to bring up beyond just the debt ceiling issue that comes in the next several months. You've got, if we see a U.S. recession in 2023, the the likelihood of Congress coming together to pass a fiscal stimulus package strikes me and strikes multiple observers as unlikely. Are you going to see a CARES Act 2.0 if there's some truly painful recession that hits in 23? I don't think you would see that. Granted, anything could happen, but that would be an additional challenge, is how do you get fiscal stimulus if needed in this sort of political landscape that we're going to face heading into 23? And on the monetary policy side, do you really see the Federal Reserve, having tools to meet, should that be the scenario? That's where fiscal policy would be best suited, but given you're going to have that divided Congress, you could see kind of a longer recession than necessary, but who knows? There's obviously a lot of moving parts. That was just one point. And then another point that's kind of tech related had to do with the journal put out some good reporting, I think, on Tuesday, showing kind of the on the real estate side, on the commercial real estate, as these, dovetailing with the discussion on layoffs, Meta, Lyft, Salesforce, all these companies that sought to expand their office space on the back of, kind of the boom they saw from the pandemic. Well, now quote, companies in the technology sector have placed about 30 million square feet of office space on the sublease market, more than triple the 9.5 million square feet they looked to sublet in the fourth quarter of 2019, according to CBRE. And the other data point was that the national office vacancy rate is up to 12.5% from 9.6 in 19. It's at the highest since 2011. And the 212 million square feet of sublease space on the market is a record since CoStar started tracking the statistic in 2005. So each market's going to be affected differently. I know one of the kind of real estate guys who's in the GMEDD server noted that Austin in particular, on the back of Meta pulling out, might see a real overbuild, I guess, in commercial real estate there. But these companies laying off workers, they obviously need a lot less office space to support the reduced counts. And now we're seeing that the commercial real estate space is really just inundated with excess capacity, it seems, at least at the highest levels in many years based on those data points. So what's going to happen when the conjunction of higher rates and are we going to start to see pain flowing through the CRE space? I don't know, but I thought that was interesting reporting I wanted to share. And if anyone has any insight or added commentary there, certainly welcome it. Add a couple other data points to see if anyone wants to chime in. But in 2021, the tech sector led all other businesses, accounting for 20.5% of US office leasing activity, whereas finance and business services sector was 16%. And that's CBRE data. So the tech sector is was at least in 21, a pretty big component of office space. And as we talked about, with this huge uptick in layoffs, there's clearly a lot of noise and pain potentially that has to flow through the commercial real estate side, and the implications obviously can spread beyond that when you think about, well, those tech workers, then they bought their lunch every day from whatever, the bodega around the corner, and now there's going to be less foot traffic in that bodega in that downtown area, and now they are out of business, and so on. You kind of have the ripple effects of, and these are obviously typically higher income jobs that are going to see these layoffs, and what's the impact on the local communities in which they reside.
So here's some quick thought, right? So tech workers are getting laid off in tech. Now that's that's really bad for tech and for or if for geographical areas that are really tech centric. Your Bay Area, your Austin and Seattle, greater Seattle area, places like that, it might be a pretty large problem. But you have to assume that a lot of other industries that struggled to match pay and lost a lot of workers to tech will probably be able to grab a lot of those back, assuming they have some amount of strength in their own industry, right? Financials are doing well so far. We've not seen any big problem in net charge-offs yet. Industrials are doing well. Defense, is one industry I've talked about a long time, and they particularly have a huge problem hiring tech workers, right? So maybe some of this gets redistributed into other industries, and it helps. So I think in some sense we are going to have a big problem in tech and maybe some level of relief in other industries, and that's a good thing overall for the economy. I think over time, it helps normalize wages in tech, where these people just got too much to not work in tech, so they go back to other industries and take what is still a very good pay, but not what tech paid. So maybe when tech does come back in whatever time period it is, they don't have to overpay to load up on talent, which they've been doing for the last 3 years. So maybe in the meantime we're going to have significant problems, specifically in areas that are tech heavy, but things improve in other areas. So maybe every ancillary industry also feels the impact of that change. So I don't know. I guess I'm a little bit hopeful here, but but at least to some extent that should start happening.
Yeah, I'm on it. You're right. I think 100%. There are a lot of companies that want to have tech engineers, software engineers, but they're competing with the Apples, with the Googles, with the Microsofts. And so by releasing some of those employees, it potentially gets jobs filled in other industries. There's also the other thing, look, that basically we had already seen a great number of staff that were in the offices reduced because they're working at home. And so when we're talking about the effect in regards to a need for office space regarding an impact of urban areas where you have concentrations of office space for tech workers, it might not be very significant if they were already working remote. And if those companies were already working at basically subleasing some of their space.
Yeah, Joseph, thanks for chiming in. You're right. If if the offices weren't already being used, yeah, then that there's not really a marginal loss of foot traffic from those workers getting laid off if they were already fully remote. Um, Thanks both you guys for adding those perspectives. Um, Dylan, thanks for sharing. I just pinned the tweet uh, from Zero Hedge conveying a New York Times report that 1,200 incremental Twitter FTE resigned on Thursday. So that's not negligible. And it gets back to, will we see a degradation of service quality from this platform? Obviously, a lot of us use it on a regular basis. The Spaces product is fantastic, and as Joe was noting, the ability of Twitter as a platform to rapidly crowdsource information is impressive, but it definitely doesn't look promising when you just see such massive swathes of people leaving, and presumably there's a lot of tribal knowledge that's going to get lost as Elon rather indiscriminately slices and dices his way through the business. But
I think users are up though. I mean, usage is
right,
peaking.
the daily active user count was up what, like 1%, something like that. I mean, Elon put his little tweet out, but it was yeah.
Yeah, no, he didn't double the numbers or anything, but he definitely has more eyes on Twitter right now than ever before.
I don't know about ever before. I know he included a 3-month chart, but yeah, I mean, he attracts media attention. So if he can keep it up while wearing his multiple other CEO caps, more power to him. It doesn't seem sustainable. I think that's probably the reality of it.
What do you mean by not sustainable?
For Elon to be active on Twitter around the clock, managing his other various businesses at a high level, I don't know. I don't see that as sustainable.
Well, he has to kind of fix what he just broke over at Twitter. I mean, regardless what anyone thinks about Elon, positive, negative, he kind of came in with like a sledgehammer and just hit all the employees out the door. And so now he theoretically at least, he's going to have to come to Jesus moment and actually have a conversation with the engineering staff at Twitter now, and maybe have a more conversational idea of how to move the company forward. Um, but again, I'm not sure. Also, regarding the people at Twitter, no one was working downtown anyway, so there's no foot traffic loss there.
Yeah, I'm just reading the Wall Street Journal reporting on it, talking about Twitter employees. Um, Quote from the story is, several employees described uncertainty about what Twitter 2.0 would entail as a major reason for why they chose to depart and take Mr. Musk up on his offer of 3 months of severance. You know, I don't know personally if there's a lot of overlap between the engineers that he has working at his other companies and Twitter, to the extent that he can kind of ship them in. Will that reduce the output at his other companies? Obviously, Twitter's a private company now, so I don't know. It's like you said, he smashed, and now he's got to, I guess, put the pieces back together of what's left from his approach. But Dylan, hey man, happy
Hey,
Friday.
happy Friday. I have one quick comment, and there's something called 996, which was implemented by Alibaba in China, and it implies 9 to
Yep.
9 to 9, 9 p.m. to 9 a.m. to 9 p.m. 6 days a week. I don't know if he's going to try to implement that. I don't know how long you've been using Spaces, but if you remember, I believe Spaces came out in April of 2021. For probably well over the first year, there was significant bugs with the product, which I could never understand how they could never figure out how to fix the product. I mean, I remember I was in a space with Lynn Alden, and we couldn't get 1,000 people to listen to Lynn Alden talk macro. It was hosted by Michael Guyot, and it just kept kicking random people out. So I think this is really going to be, I think this is going to end the complacency, because again, Twitter Spaces, it's excellent product. I think it's probably their best product that they've launched. But the fact that after it's launched for a year, you still have significant bugs in the product, I think the layups are a good thing, and it's going to it's the equivalent of a kick in the ass, is how I would describe it.
I don't know, Dylan. I mean, with people who left the company, I mean, how do I say this, dude? The idea of going into it. Okay, first of all, I live in San Francisco. Okay, the idea of having to commute down to that office on Market Street. First of all, that commute sucks. To begin with, and to go in there with a boss that's now going to expect you to cover the work of half the company that just left their jobs and now probably work all mandatory overtime. I wouldn't want that job. I would not take that job. If I had easily transferable skills for another company, I would get the heck out. Because who'd want to deal with that and have a crazed boss over my head trying to basically work me to death because he's trying to make up the margin of all the overspend he did to just buy Twitter?
That's a very fair point. I'm outside. I'm in the suburbs of Chicago, so I don't know quite how bad the drive is. Mine was more about the fact that there seemed to be a sense of complacency. And again, I've never worked at a tech company, so there may be something a lot. It may be a lot more complicated than I'm thinking. I was thinking the fact that Spaces was launched for a year and there was significant bugs, and I hope I'm not the only one who saw the bugs. I'm hoping everyone on the speaker panel can agree that again, people would get kicked out, or you couldn't hear people, or there was a size capacity limit, and it seemed like why was this product having this much issues? I could never think that Facebook would never launch a product like that, or Meta, I guess now, or one of the other players would never launch a product with this many bugs.
Well, you have to think about it, Dan. What was the focus of Twitter at the time? As far as I could tell, the focus of Twitter was basically on monitoring speech, not basically maintaining technology. And if
Right,
that's
but
where
how
you
many
put your
people
go
does
ahead,
it
go
take
ahead.
to monitor speech? And again, I don't want to say that they were monitoring everyone's speech. There was a few high-profile accounts that they were focused on. Maybe they didn't like what they were saying, but I could never understand why they couldn't get Spaces correctly.
Well, also, Dylan, correct me if I'm wrong, a big thing was it was a reactionary product to Clubhouse as opposed to, and maybe they were already building it internally, but I thought it was more of a them reacting to seeing Clubhouse rapidly kind of take some share, and that they put out this rival product, it's the Spaces product, which I'm with you that there were extensive issues as a user of the product, but I think we both agree it has a lot of upside. It's just a question of, yeah, where is it going to go in this new Musk world?
But it comes down, I think, really. I mean, Dylan, I'm sorry. I used to work over at CBS Interactive, and so I have some acquaintance in regards to engineers and tech and resources and how they're allocated. And if the powers that be that are at the top of the food chain at Twitter weren't really focusing on spaces, and their focuses was on something else, that's probably where they put their resources and their goals and their expectations. I don't know if I've ever really heard anyone really chatter before at the high levels of Twitter about the importance of making spaces effective. Only thing I ever heard about over at Twitter is making sure they were monitoring speech.
Well, I think it's been an open question whether Twitter was ever run as a business rather than as a service that contributed to humanity in some sort, right? So transitioning away from that view to make it a viable business is itself a big deal. And to your point, Joseph, I think my worry about Twitter is that pushing these people far enough, you're going to be left with people you don't want, and you're going to lose all the people who are really good. And 2x the output of not good talent is not really going to make it better.
Yeah, I'm not arguing with you, Mont. I mean, I think we're looking at basically, and that's why I said it, individuals who are in a place where they can easily transition through either skill set or just mentality to other companies. Um, I don't think anyone in that sort of position is going to want to take any of the bullshit being in Twitter and having a bunch of people over them yelling at them to go faster and work longer hours. I sure as hell wouldn't do it. I would take my severance and say, thank you very much, goodbye, and go somewhere where I could actually work normal hours and not find myself in a position where my expectation of my job was something that, as far as I was concerned, something I did not want to do. You know, I'm sorry, dude. I mean, I wouldn't want to work basically like 48 hours, 50 hours, 60 hours just to make sure that the person who bought this company can make up his money on this overspend for buying a product. No freaking way. I want to be able to go in and work respectable hours, have some work balance, not have to commute downtown, which is a sucky commute, you know. Um, and so the people you have left are people who basically don't want to transition out for whatever their reasons. They may not be bad employees or will have a low skill set, but they probably just don't want to have to deal with the bullshit of getting another job.
So before King Davis speaks, if I could just offer a comment, that brings me to my second point. And actually, I think the Twitter layoffs are going to be good because you have certain employers that are basically starved of tech workers because they weren't able to compete with them. They weren't able to hire a software engineer or a data scientist because the data scientists wanted to work at Twitter, right? They didn't want to come work for perhaps a non-glamorous company, or perhaps the pay package wasn't quite as good. So now you're going to have these talent go to other industries, and I think it's going to be a net benefit for the economy, assuming that there aren't hiring freezes and layoffs, assuming there are open jobs, which there are open jobs because there's, even though Monative will say that we are seeing a recession in white collar jobs, there are still employment options for these people.
Yeah, and just really fast, because Mont was talking about it also. The only issue, and it's just been particular to the Bay Area, is you have such a high level of layoffs that are tech focused, and we are more of a technology focused industry around in the Bay Area. I'm not sure how much absorption there is for those persons to take jobs locally. I don't know, but I guess we're going to find out.
So I just wanted to ask Joseph, or really, I just wanted you to think about it from this standpoint. Imagine if you were, 27, 28 years old, very talented, like computer engineer, smart kid. You have a pretty good understanding of the world's going, the impact of social media on the world, and a company, and you're also hardworking. Like you love your job, you're hardworking, you want to do something innovative. And, sure, let's say you don't, your ideas of the world and kind of your vibe doesn't really align with Elon Musk, but at the same time, you're smart enough to realize that this is a guy that turned a car company into an over $1 trillion company. And people say, like, even though he's really not. Like, he's the artificial intelligence guru of the world with this neural, all these different things that he's done. I mean, that's crazy. Like, it's an energy, it's a capacity to influence the world around you in a big way. That's what Elon Musk has done. He has impacted the world around him in a massive way. I mean, aside from politics and like what, I mean, isn't that enough to stay if you really are talented? And like, aren't those the types of people that you want to stay? Like, and everybody else should just fucking go. Like, you see what I'm saying?
I
No,
mean,
no,
I
no.
totally agree with you. I think
Yeah.
like there are going to be people that see his vision and want to work for him purely because of his preach that he wants to change the
They want to
world
have an
and
impact.
free
They want
speech.
to
Yeah.
they want that to be their life story
Mm-hmm.
experience, right? To work with
Yeah.
someone
And
like
then,
Elon. It's Elon, as much as he's smart, it's the idea of him that is
mm-hmm.
so magnetic
Exactly.
and he manipulates the world, man. He just does. It's just how it is.
And it's not going to be appealing to some people, obviously. A lot of people are going to be turned off. I mean, Joseph, I'm not trying to pick anything, but your bio says you're a chill guy. And it seems like that's not the kind of guy he wants. He wants someone who's, all about work, doesn't really care about the balance and wants to change the world. So
But
it's
what type of
definitely.
guy is going to produce a product? Like, I imagine being innovative and thinking outside the box.
Mhm.
It takes immense amounts of research, and that's not easy. So who you got to think, what type of person is going to produce something that's game changing for this company? Somebody busting their ass. I'm telling you, the hard worker beats the smart worker every time.
Professor Joe, when I say I'm chill, I mean basically I don't freak out. Not
Of
that
course, like I'm
I'm not
not trying
stoned
to.
out. It's not that I'm stoned out. It's just that basically I don't let things basically rile me. You know what I'm saying? And react badly. But I don't disagree with you, King. I mean, and I think this is the problem I think that came in with Elon. He didn't come in with the carrot of what his vision is and to get people excited to go into Twitter and stay with Twitter. Let's make something amazing here. He came out with the basically, the stick and said, I'm gonna smash this part. I'm gonna beat you up if you don't do what I want you to do. It wasn't this he didn't come into the team saying, let's make something amazing like he was doing at Tesla, like he was doing basically at SpaceX and all those other companies. He came in with a stick. And I'm sorry, when people see the stick, who was going to hit my stick?
I think he wanted to get the divisive ones out, and that was the best way to do it. How do you interview people?
I'm not going to argue with you, but I'm
Yeah,
just
but
saying.
how
I'm
do you
just saying.
interview people and say, hey, do you do you think you could get in line and not talk shit about Elon like while you're working throughout the day? Like, how do you figure
Yeah,
out
I
something
can.
like that? Yeah, like
You know
you
what?
go in there, you tell everybody, I'm going to make your life miserable, literally miserable, and
You know
everybody
what?
that doesn't like him, they're out, right? Because that's the most offensive thing that he could do, right?
Probably
King.
more than just the people
Yeah,
that don't like him are out as well.
exactly. So, King, like I live here, and I was thinking for a moment, do I want to go work there? That could be an amazing experience to go work for Elon and make something happen there. And I thought,
Exactly.
hold on a second, huh? I have to commute down there. I might have crazy expectations because right now all I'm seeing is a stick coming on. Ew, I don't want to do that shit. I rather just make lots of money as a day trader. Fuck that.
Well, I think if someone's vision to change the
If you're
world is
young,
halted because they have to commute, then it's probably not someone he wants.
yeah. I mean,
Yeah.
what I'm just trying to say, it's just like, for me, it's like that's not what I need or want. You can't. I mean, the amount of money I could make working for Elon would be a tiny fraction of what I make on any given day. I'd make more basically in a day than I would make in a month over basically Twitter easily on any given month. So it's like no. But for someone else who's looking for something exciting and make a difference to go in on the ground floor and get involved in in this transformation and metamorphosis of Twitter, I think that's a great experience if they're up for that. I just know that for myself, it wouldn't pay me enough.
Well, I'll say this. I mean, and I'll use becoming a physician for example. It's so hard, man. It's dreadfully difficult. And I mean, don't you trust more so someone that has like been through the grinder to handle your health care than someone who was told like, hey, don't worry about it. If you figure it out, good. If you don't figure it out, you don't have to work hard. You know, just do the best you can out there dealing with people's health care. Like what type of worker would you want taking care of your health, for example? And I think that you could apply that same thinking in the instance that, with Twitter. Like, I want people there that are going to produce something. They're going to work hard, and that's in their mind when they come to work. They're here to work hard and to make a product that's going to better this platform. Especially think about when they bring AI into the picture. You need some smart, hardworking people there to like figure out how to make something like that uh, add value to a platform and just not be a complete wreck or mess. And
Yeah, but I think King, and it's something that Monit was talking about briefly. You really have to change what the focus and direction of the company is. If the individuals who were working at Twitter, their focus was on basically um, making sure that true speech, as they perceived it, was going out through basically Twitter, and they're the gatekeepers and the guardians of truth, and that was the culture and the focus of the company. Um, and that's very different if you're taking a very different emphasis on what you want that company to be. And that means you really have to have a total change of culture and an emphasis of goals. And that's the hard moment. With people who were there, and what percentage of the individuals that were over at Twitter were going to want to embrace a very different mission statement than the one that, be it official or unofficial, was being pushed out by Twitter before. You know what I'm saying?
yeah, I mean, I just got on Twitter 5-6 months ago, so I mean, I can see that being the case. I didn't know that was kind of the mission of the app, but I mean, that makes the most sense. I literally my whole life have never used Twitter other than like starting 6 months ago. So yeah, I just think that we're going to see something really interesting out of Twitter, and I think it's just going to have a complete makeover. And I think that's what you're saying, is that it's probably going to be just so different than we probably can imagine. Any of us can really imagine, because you can't really predict, right? And I'm just thinking that someone like Elon can really, and I mean, he's just so popular. I don't see how people won't be drawn in to use Twitter when they hear that it's a changing platform. I don't see how that's not going to draw people in, because everybody knows what Elon Musk is doing. I mean, I'm not a big Elon Musk fan, but I don't even think he's that smart. But I think that he knows how to work the world around him. So
So I'm just going to read off. This is a survey from May. So granted, I'm sure a lot has changed since then, but the favorability versus unfavorability for Elon Musk. So 29% were either somewhat or very unfavorable, 40% were very or somewhat favorable. So I think your point about popularity, I think he's the most wealthy man in the world as of this point in time, and he's well known, sure. And as Joe noted, I think the average user accounts have ticked up modestly since this, but he's also quite a divisive figure, as that survey data show, at least. In terms of, some people certainly dislike him, some do like him a lot. I don't know if he doesn't strike me as someone who hews to the center and makes things collaborative and is willing to reach out to people with the different viewpoint so much. Perhaps I'm wrong there. I know he says he wants it to be the freest speech platform in the world, but he on the same token,
well,
then
in fairness, how much of that is just, and I'm not trying to be offensive, but you just trying to make him fit into a stereotype, or other people trying to make him fit into a stereotype that's not true.
I'm not sure what you mean.
Like, that he's divisive, or like, he's this rich guy, doesn't have good intentions, yada yada yada. People that are typically rich, people, kind of poor people, assume like, the Illuminati will say that, or they have bad intentions for humanity because they're rich, or you see what I'm saying? Like, I just wonder how much of that 29% don't really even know anything about him, and
Well,
just
there
hit
was
it.
a response for heard of no opinion. 22% replied heard of no opinion. 9% had never heard of him.
So Rod, again, I'm speaking maybe from Wall Street bets, but I assume the massive fan base around Elon Musk was because so many retail investors had, and I'm speaking my own book, so many retail investors had made so much money on Tesla stock. Again, for the
The
average retail
OG
investor,
meme stock. Yep.
yes, correct. And Tesla stock was the biggest winner for most retail investors, individual portfolio, probably in their history. And then you also there was a political argument. This was a guy who was building electric vehicles. You had the, certain political people that, really believe in climate change, and this was the solution. So he had the fan base. A lot of people used to buy Tesla as a political statement. You kind of knew who they were voting for if they drove a Tesla. So I think that's who largely their fan base was, and the people who were most critical of them were the Tesla shorts. These were the people that again, I'm not bashing their work that they had done on shorting Tesla, but they had lost so much money. And again, when I would hear the people who were critical, even the people who are critical, the Tesla Q crowd on Twitter, they're all short sellers.
Hey, Monet, are you there? Monet? Maybe not. I was going to ask Monet because I live in San Francisco and he lives in the peninsula. I never thought of people buying Teslas as a political statement regarding parties and such. I thought it was more basically an ecological statement regarding green and getting electric cars. But that's my interpretation of the individuals who buy Teslas who had bought Teslas here, at least in the Bay Area. It was more of a green thing than basically a pro Tesla Elon Musk thing.
Well, if you wanted to fight climate change, you didn't fight climate change by buying an ICE. You fought it by buying an EV. And actually, there's research that's been published. If someone owns an EV, what party do they vote for? Versus if someone owns a truck, they likely vote for the opposite party. And this is pretty widely accepted research, market research that's been done. So yeah, those were the early adopters of Tesla. Particularly really until 2015 when Tesla EVs sort of became mainstream, or 2016 they really became mainstream, and people who didn't necessarily care that much about climate change were like, wow, these are really cool. For instance, I want a Tesla. I don't care at all about climate change, and I really want the car, whereas a lot of people that originally bought the car, they bought it for a specific purpose.
Bro, they're fast as all get out, man. They go 0 to 60 in like 2 seconds. Blows my mind.
I don't know. I just see them at the supermarket.
Right, but you're in California, you're in the Bay Area. Your political leanings are far different than probably most people in this space, with the exception of Monative. So again, you see Teslas everywhere, but if you also polled the people, how do they, what political views do they hold? It's completely different than perhaps the rest of the country.
Yeah, I don't
or to the same degree as the rest of the country.
No, I fully understand what you're saying. Yeah.
So Model 3 launched in mid 17, and look, you can't refute the reality of the success that Tesla's seen in the last few years. I do question the durability of the growth rate, and that's where the arguments I think come into play. You've got a lot of the Tesla mega bulls who've made life-changing money and who believe that the rocket ship will never stop. Stocks only go up, right? But I think a lot of the folks, and not everyone, I mean, certainly there's some folks invested in Tesla who've been invested for a decade plus and have a very long duration view. But Dylan, to your point, a lot of the retail investors in it, it's Elon's stock makes me money, so I like to trade it. I like to own it, as opposed to, when I think about what I expect the growth rate of this business to be, and what I think that their free cash flow generation will be, blah, blah, blah. I don't think they're going that deep in their analysis of their decision making to buy Tesla. It is a little bit of I think, the cult of Elon, and I've made this point before, that when I've heard so many people note that they think that by buying Tesla stock, they are effectively buying stock in Elon Musk, and that they have access to all of his investment portfolio, as opposed to they're just buying what is still chiefly a car maker. Granted, to King's point, there's other forays that they've pursued, and they've raised a lot of money selling a lot of software that has yet to come to full fruition. The FSD, look, Autopilot is a level 2 ADAS product, and it's a great product, but it's a level 2 ADAS product. And what he's pitched for many, many, many years and said it's right around the corner for many, many, many years has not come to fruition, which is not to take away the success of the electric car production and sales. But I think he gets a little bit of a, for his supporters, he can do no wrong. And for some of his detractors, he can do no right. I think the truth is certainly in the middle somewhere. But I think Chancery Daly said it well that, that you're the world's richest man and you're pushing the envelope, you will be scrutinized, and that scrutiny is deserved. And he seems to abhor scrutiny to the extent that it just raises the eyebrow of folks who I think try to look at it from a neutral perspective, that you should expect that scrutiny, sir. Why are you so opposed to it? But I don't want to put too many words in her mouth. I think she's covered the entire kind of trials that's going on now with compensation, as well as the trial for the closing of the deal potentially as well, very well. And I think that she laid that out well, that it's really a matter of him seemingly pushing back on the idea of scrutiny that that I think is deserved. I mean, if you are the richest person on earth and you're making these pushing the barrier type actions, that scrutiny, why wouldn't it be expected, or why should we
There's
push back
certainly a
on it?
lot of empty promises. He's made a lot of promises that really since 2016 that have not come to fruition. It's always by the end of next year we're going to have X product by the end of next year. But I can think back to when I was in business school for my undergrad. Tesla itself was brought up more than once. Not only by professors but by fellow students. And this is 2016 to 2017, 2018. There really is a cult following, and they again, I held the stock. They give him a lot of forgiveness, right? They allow him to say by the end of next year we're going to have X product. When next year comes around and it's no product, and then he pushes it off to the next year. I mean, robo taxis, full self-driving. He's been promising robo taxis since 2019. There are no robo taxis. He's been promising full self-driving since the end of 2016. There is no FSD. You're right. It's a level 2 system, which is now it may be the best level 2 system that's commercially available, but it's a level 2 ADAS.
So what other topics, if we don't want to only be talking about Mr. Musk, uh, can we segue toward? But I think the discussion is great, and thanks everyone for kind of chiming in. I enjoyed it, and if we want to keep talking about Elon, we can. I mean, I've done plenty of work on the space. I had the opportunity to sit in a Tesla Semi prototype in 2019. I mean, I think a lot of I was a day two Model 3 reservation holder. A lot of my personal skepticism is borne out by what you just said, Dylan, that there's the waves of promises unfulfilled overwhelm, in my view, the things that have been done. But that's just my personal opinion and my experience as someone who's followed them quite closely for many years. And it's like that he can't keep getting away with it meme, that he can continue to sell this product, the full self-driving product, when it's pretty clear that at some point in 2019 he realized it was not going to come to fruition. But can you prove that he knew what he knew when? I mean, that's a question beyond my pay grade. Uh, and I think the proponents will say, no, it's just a matter of when, and the detractors will say it was a fraud all along, and maybe it was somewhere in between, that they thought they could do it when they'd hoped to. But I mean, look, that's the reality in the autonomous vehicle space. There's been a lot of reporting in the last few months. I mean, you've obviously seen capital spigots get turned off by and large, and when you look at how much money these companies are burning, I think, Dylan, you might have been the one who talked about Too Simple, and you noted you've got hundreds of data scientists and computer vision specialists working on their solution for autonomous driving. And if you don't have a commercial product bringing in money, how many years can you go in development for that sort of a thing before you simply just run out of runway? And those runways have shortened significantly, and there's probably going to be more consolidation of a lot of these startups, which isn't to say that full self-driving, a level 4 commercial offering. I mean, we obviously have limited offerings from Waymo and from GM's Cruise currently in operation in a few areas. But like the promises that were made by many, and it wasn't just Elon, about we're going to have level 4 autonomy right around the corner. And that is just simply not borne out. And I think the realization now is that many tens of billions have been sunk into that, and that there may never be a return on that investment for most of these players.
So you have Embark, which is likely a zero. You have Too Simple, which they have some FBI issues there with misallocating IP. That's likely a zero, although they have about 18 months of cash. And then you have Aurora, which is also a zero. Aurora has 1,200 employees, and they have no cash flows. They're burning, $500 million a year. Now they have money from going public via SPAC, but when the money runs out, the equity's worth nothing. These companies are likely going to fail, and unfortunately the employees are going to get laid off. But they told a very compelling story, and again, I held shares in them at one point. Luckily it was profitable, but I don't think the story is going to materialize, unfortunately, because I was really hoping that their future that they were painting was going to materialize. It sounded very cool, but it doesn't look like it. They pushed them back. It was supposed to be 2024, and now, Too Simple, it's saying 2025, and Aurora is saying 2028, which is a little bit different than what they told their SPAC investors during their D-SPAC. And it's just, I think they're headed for bankruptcy. I think it's going to be a broken promise, unfortunately.
And I think it's important to remember that the purpose of autonomous driving is to realize some sort of an economic benefit. And a lot of, you mentioned Embark, Too Simple, and Aurora, and a lot of that is on the truck side, where it inherently makes a lot of sense if you can remove the labor cost of the over-the-road truck driver. That is where you can really realize some impressive network effects, scale economies, whatever, in terms of really shifting the way that transportation works in the country. And you think about the consumer, the robo taxis, right? The million robo taxis by whatever year it was that Elon initially had promised. I mean, it's a very different one. It's a more challenging one too. So I'll say, I think most listening know, I used to work at Ryder in corporate strategy, and Ryder has some different relationships with some of the companies that you mentioned. There's like intermediate solutions for this stuff too. That's interesting. Whether you think about, you have that intercity, driving that's really complicated. You have a lot of pedestrians to worry about, a lot of edge case situations to worry about. But then, Embark and some of the others, including Too Simple, has the idea of, well, depot to depot, over the highway run on I-10 from Southern California warehouse to a Dallas or whatever warehouse. That is the type of thing that the technology could solve for sooner versus later. I know in my conversations with McKinsey and BCG folks, like the question was, how many years do you have? Is it a decade? Is it 2 decades? Do you have where you have this kind of let the truck manage the highway portion, the low complexity portion, before you get a true end-to-end solution with autonomy? But I mean, as we kind of said, the the expected commercialization timeframes have just simply continued to get pushed out and out and out. And it does seem like it's just going to be a matter of, well, in a non-zero interest rate world where we don't have visibility into when commercialization happens, this is the type of thing that will come from an existing player working on this internally, as opposed to maybe just a random startup whose oodles of capital are thrown at them and they're able to burn cash for 5+ years. That world has changed, it seems. But Tesla Semi, they say Pepsi will have up to 100 of them by year end, 5 years after the fact. And look, whether Tesla did or didn't manufacture them, it is irrefutable that simply them taking that action on Semi in 2017, when they did that, it's almost 5 years ago to the day that they did the announcement of it with Roadster. And look, that pushed Daimler, that pushed Traton, formerly Volkswagen, that pushed all of the incumbents really to accelerate their development. And look, the incumbents have commercial products available today, unlike Tesla, when you talk about the truck space. And there's a good, I think, report in Bloomberg that really just highlights the question of how much incremental energy supply and throughput do you need at things like truck stop and rest stops and other to enable the necessary refueling if we do shift. 70% of freight moves on a truck, and if you're going to try to actually electrify over the road freight, you need a huge amount of infrastructure, and we're talking about having the capacity to power small towns in some of these rural, truck stop areas, and that the infrastructure build really needs to be going on now. If any of these, high-reaching hopes of adoption rates can be achieved on like the commercial vehicle side.
Well, I think this is all going to be short haul trucking because there's no way you could do long haul trucking. Long haul trucking 300 miles in a day. You can't do that with the electric Class 8 semi. And then I also think that it's probably there's a political element to this. And if you read the Vox story with Sam Bankman-Fried, where he sort of talked about it all being bullshit. Sorry my language, but I think Pepsi wants to be able to please people by saying we're going green. So we bought some electric semis and we're going to use them for short range trucking, and whether they do really work out or not,
And to
it's good
Pepsi's
PR.
to Pepsi's benefit, I mean, having worked closely with them at times in my past, like they were always on the leading edge with this, exploring hybrid electric back 15 plus years ago in their trucks. And if you think about Frito-Lay, they are the perfect type of truck. It's a volumetrically constrained application. It's potato chips, right? It doesn't weigh a lot. Now, if we're talking about soda and beverage, that's a little bit different. But to your point, if you're doing local, replenishment to grocery and to other stores on a truck that, you don't need massive swathe of battery packs, you can actually make an economic case today, especially on the back of the Inflation Reduction Act, adding that up to $40,000 benefit. The Rocky Mountain Institute is an entity that's done significant research and work on space, and I think they claimed it's like a 5 to 10 year accelerant for total cost of ownership break even versus internal combustion. And of course, it will vary very much by application. Um, but you should see more of that. It still becomes a question of, you know, it depends by depot too. Like, you have to do significant electrical infrastructure overhauls if you're trying to enable, charging dozens and dozens of big rigs. If you're trying to charge maybe a handful of box trucks, maybe you don't need to do an altogether substation build, like, to enable that amount of energy flow. But a lot of this stuff is stuff that a fleet manager would never have thought about, and that the lead times on a lot of this work is 12-18 months. If you're in California, like, the permitting and all that takes just so long. So, I say this as having for 5 years at Ryder been hyper focused on electrification, because for Ryder it's a risk, actually, because their bread and butter is the maintenance and wrapping that in a lease for the equipment. So if you eliminate maintenance, your value add is diminished. Certainly we're hyper aware of it, but no, I mean, I can riff on this, but I doubt the audience cares too much to talk about electric trucks for too long. Let's see, 5:41. So we've been going for about an hour and a half or so. I'm happy to keep going down this line of discussion. Otherwise, anyone who wanted to ask any questions, change the discussion in a different area, I think we'll wrap shortly here. So, final call for any follow-up questions, thoughts, anyone would like to chime in. What's up, Turtle?
Hey, Rod. Happy Friday.
Happy Friday.
Don't want to totally 180, and sorry if we talked about this earlier, but what about have you guys done any work on SI? That looks like such an interesting piece of shit.
To answer your question, no, I've seen it. Kind of, a lot of folks have been talking about it. What are you thinking about it?
I don't know. I don't really have thoughts. I was surprised how easy it is to get a borrow still. Made some money like just trading it just over the last couple days, and haven't really had time to sink my teeth into it too much. But yeah, I mean, Coyotes has been dead on the money so far. And actually, what's funny, I'm going to do some more homework on it this weekend, but what's funny is, like, you go back on Real Vision and there's like an interview with the CEO, and he's talking about, and it's like, I think it's like a clip, like, why Silvergate is the bank of the future. And it's like all the bullshit he's saying sounds so bad now, right? But at the time, he's using like, yeah, 24/7 banking is just the way of the future. Like, why would any bank just be open 9 to 5? And like all this, like all these, I mean, even that doesn't sound too bad in and of itself, but just kind of the way he's talking about crypto, and I don't know, it just sounds really bad. Maybe about 9 months later, or about a year later. Now that.
Yeah, like you can tell the red flags.
Yeah, right, exactly. Yeah, it's like it's just a lot of buzzwords, and it aged really poorly. So I got to do more homework on it. But I was just curious if you guys had looked at it. Yeah, I mean, is it a zero? I guess is the question. It's got $1 billion of cap still, and how? Yeah, is it a zero? That's I don't know. Or is it now getting to the point where like MicroStrategy, where maybe there's a little bit of a I've seen some analysis on MicroStrategy where, yeah, I mean, now at this point, it's pretty beat up, and there's you're almost kind of getting there's getting the cigarette butt point.
Oh, to consider longing
Yeah,
MicroStrategy?
I saw an interesting presentation on the bonds recently, on like some senior secured bonds, not necessarily the equities, but the common, but
Secured by Bitcoin.
no, just like, no, it's a MicroStrategy bond, right? That's secured not just by Bitcoin, but by the the entity. And the analysis I saw actually was from Special Situation. Jay Singh. I think he does really good work. And yeah, I don't know. But yeah, he made some interesting points regarding how 13% a 13% yield. Now that this thing's, I think it's trading at like 65 cents. The bond he was talking about. So anyway, but. Enough. I think the the point is that it's like we're seeing crypto melt down, and the question is like some of this stuff, GBTC, right? 50% discount to NAV, but is Grayscale going in so like it's just moving so fast? It's moving very fast, and it's like separating wheat from chaff. You know what I'm saying?
It definitely strikes me as, if you're really in the know in the space, there's probably some great opportunities, long or short, if you really truly know. But if you don't, you're probably best suited staying on the sidelines altogether, as opposed to getting your face ripped off one way or the other. Not knowing the depths of the contagion and the relationships between whose money is locked up with whom. I don't know the space well enough to have a great informed view. I mean, I've always been, and I know Joe's owned Bitcoin, I think, since he was in middle school. So, Joe has his own perspective. I've
Yeah.
very, very much been a never, coiner until I started dabbling with it, as the mania got to me, last year a little bit. But I'm by and large of the view that the entire space has a lot more down to go, and I'd rather, for me personally, I'd rather wait to see the dust settle before I considered making investments in the survivors. But that's where the opportunity is, to your point, Turtle. If there's some debt that's just grossly mispriced based on reality, I mean, more power to you, man.
I'm with you on that. I think Ethereum in specific and the other coins that promise utility have a lot further to go down than Bitcoin does, just because this utility isn't happening anytime soon. And people are going to realize, that tradable JPEGs was a fad, and the actual utility is not being implemented.
Yeah, love it, guys. I think that's great. Great points. Yeah, a lot of I think that makes a lot of sense. And yeah, you're right. I mean, definitely, having a hunch or something like that's a great way to get hurt, like you said. And that's
it was smart to buy Russian securities when they were in free fall, right? And then
right. No, exactly. Yeah, no, it's a good point. And I think to really, like you said, know your way around that space, you probably would have to be pretty, at this point, you'd probably be pretty involved, and that would have its own drawbacks, I guess. So no, it's yeah, you make a lot of good points. But I think there's some interesting, that there, there's some interesting like pairs to be had, right? Yeah. Anyway,
That's
I
a good
think
point too. Like if you can identify, I think this is the absolute worst of the worst. Short that and marry it with a long, but that stuff certainly gets challenging and risky for people in different ways. But there's opportunity for sure. I think that the lack of information for most, like, to truly understand liabilities some of these entities have, uh, is beyond me. It's definitely not worth me going crazy digging into personally. But because I say that, right, that's where the opportunity resides for someone who may be willing to really dive in and find where there is in fact opportunity in the crypto space. Um,
no doubt, and I'll pop off the stage here. I just wanted to ask about the SI thing, but the last thing I'll say, like just to clarify that thought a little bit, one more sentence on that is the GBTC, right? Like we said, so I guess Grayscale's having all these issues, but it's literally what, a trust trading at a discount to NAV of 50%. That's pretty interesting. And they've got that lawsuit that they could, I guess in theory, still could possibly get approved as a spot Bitcoin ETF, and there you go. But boom, you made 50% in a day. But anyway,
it's
great
pretty
space, guys.
crazy.
I think you guys
Even
crushed it today. Yeah.
Thanks, Turtle.
Pop
I'm
off.
looking at the grayscale. It's just wild. You look at since inception, it's still up over 10,000%, and that's even after being down 72% over the trailing 12 months. Just incredible. I mean, I'm still of the view that I could very easily see all of these digital currencies go very close to zero over the following years to come. I mean, to Joe's point, if there's not really utility, why does it exist other than to speculate with? And it seems like the appetite of the speculator, in this back to world where people can bet on sports again, and there's less incremental discretionary dollars to do such speculation for maybe smaller retail traders. And unless you see like some regulatory certainty, you would think that institutions by and large will still only dip a toe or two in the space and stay sidelined. So I mean, that gets back to our discussion on, will there be some sort of regulatory response from Congress, from the new Congress, on the back of this whole FTX blow up? If you got some clarity, that could enable more participation by institutions who might have been reluctant to date. I think we all, just as humans, got a lot of FOMO watching what's happened or had happened. Thinking back a year ago around the last top, everyone thought it was going to keep going up, right? Like the people who were long those things, and obviously it's been a wake up call. But I'm sure that there will be no end to the discussion on whether crypto deserves to die, or or if it's just refueling on the next, ready for the next moon mission. But you're right. I mean, these discounts, like, there's a lot of weird nuance, Turtle, and that's where I think someone who really can understand where the like liability and whether whatever part of capital stack you're like looking at, there could be opportunity there. But obviously there's a lot of risk due to the amount of uncertainty. So we'll see what happens. But good. Hey, this was great, guys. Thanks to everybody that joined, speakers, Turtle, Dylan, Montiv, the guys who have since dropped down. We really want to make this a valuable conversation tool in everyone's toolkit. I mean, just to kind of shill Wook Capital and remind people who might not know what we're all about. I'm the managing director here. It's a private investment fund that John Kim founded on the back of very successful investment in GameStop. John was among the largest investors in GameStop until exiting in January of 21, and using the success of our kind of crowdsourced research throughout 2020, seeing that kind of come to fruition, and seeing the opportunity as this world is more and more connected, and you can get really unique and informed perspectives from people that you might not have always been able to connect into their networks. We're trying to build this information network. We're trying to put out programming that people find valuable and informative. And we haven't done so much yet on the financial analysis side. but we are certainly planning on upping our earnings call coverage. I think an intention of mine is for us to begin to cover some of your kind of blue chip macroeconomic bellwether companies on a quarterly basis, starting in the fourth quarter 22 results. So really next earnings season, that's the plan. I don't want to overcommit and underdeliver, but that is a plan of ours. We also have a Wook Book Club series that our second book that we'll be covering is actually a collection of Howard Marks memos. For those who don't know, he is one of John's favorite investors. He's the co-founder of Oak Capital Management. He is a well-renowned investor, and his investment memos, the most important thing. I have the details as well as link to the PDF in our Discord. You're welcome to join. Again, the only barrier to entry is we simply ask that when you join, you introduce yourself. So wook.gg is the server. And we'll continue to put out these weekly Wook and Review newsletters and presentations on Fridays at the close. And then on Wednesdays at 7, Joe and I just kind of have been hosting an informal discussion on our personal accounts. So with all of that said, thank you everybody for tuning in and for your interest. And I hope that everyone has a great weekend, and we will catch you on the other side of Thanksgiving, and hope everyone has some good time with family. So stay safe out there, everyone. Have a great weekend.